Good day, traders. This is the daily market update live from the Tradelo trading floor. It's Friday, the 26th of April, and highlights from today's show. GOOG valuation set to soar above the $2 trillion. US stock market has climbed the wall of worry, and the BOJ is gambling with the yen. Let's get straight into it. The big overnight news, obviously, Microsoft reported solid earnings, and so did Google, but Google was the interesting one. Why? First ever dividend has been declared. Now, this is highly unusual, particularly from a growth tech stock, and it's very much a take from the Meta play that we saw back in Feb when they too declared this earning, this idea of giving back cash to investors. Now, why does this matter? Well, if you cast your minds back to late last year, there was some fear around Google, and in particular Google search, that they were ultimately falling behind in the AI race. And as a result, their primary revenue driver, remember, Google generates majority of the revenue through search, and there was concern that their primary revenue generator was going to come under threat. However, those fears are now truly gone, and Google is heavily investing into AI. Not only that, but they're also ultimately giving back cash to investors. And this makes it a double play for Google moving forward. It means that Google is not only a play against AI, but it's also a dividend-bearing stock, as the CEO has told us they expect to pay dividends in the future. Now, if you go look at the Meta chart, very importantly, what you'll notice is that before Meta came out and declared that dividend, the stock had already rallied 70%. Now note, if you go and look what Meta did after the declaration of the dividend, it rallied another 14-15% after the gap up. So keep a very close eye on Google. It looks as though we should have another 10-20% rally in the near term over the coming days. So that is definitely a pick to be long Google. Now, the key risk event for today is US PCE data. Why? Well, yesterday from the US, we had Q1 GDP read as well as the Q1 PCE read. And there are some definite concerns being raised about a stagflationary environment. Why? Well, because that GDP number came in a lot lower than expected, around 1.6. Now, that in its own doesn't signal stagflation, because stagflation is zero or low growth. However, it's quite a significant drop-off from the Q4 GDP read. Moreover, the PCE data came in 0.3 higher than expected. In other words, we're seeing a scenario where growth is slowing quicker than expected and inflation is speeding up more than expected. And that's where the stagflationary concerns come from. Now, why does this matter for today? Well, because yesterday's PCE data includes the print we're going to see in just under 2 hours. And everyone is squarely focused on that PCE. Why? Because every investor wants to know, was yesterday's beat in the PCE because today's numbers likely to come in higher, or was it a case of the January and February PCE data was revised higher because of seasonal effects? And that's the real key answer we want to be listening out for today. If that number comes in out hot today, comes in around 0.5, there is some expectation, there are whispers on the street that the number is going to come in hot today. So keep a very close eye on it. There's some hedging ultimately for a higher number as a result of yesterday's PCE number. So should that number come in at 0.5, well, that's going to put a bid back into the dollar, and ultimately this equity rally that we've had over the course of the week will be tested. That said, twice this week, if you go look at the S&P daily chart, it's been bought very, very aggressively on the dip. First at 49.60, again at 50.20 yesterday. So we're seeing this dip buying re-enter. And that's ultimately why I believe the S&P is starting to climb the wall of worry quite comfortably, because ultimately, should that PCE come in line with expectations today? Should we see a 0.3 month over month for the core in the headline? This will ignite a rally back up to record highs for US equities. Ultimately, keep an eye on that 10-day VIX. We can see that average has now turned back lower. We've returned to that environment ultimately that we've seen over the past 6 months, which really aided the S&P rally. Now, don't forget as well, if you have a look at what drove that rally since October, it came down predominantly to 3 stocks. 1, Meta. 2, Nvidia. And 3, Microsoft. 3 stocks drove that rally. They took everything else up with it. It was very much the AI rally. Now, keep in mind, yesterday we had GOOG earnings, which were good. We had Microsoft earnings, which were solid. We also had Meta earnings that were actually quite good, despite Zuckerberg telling us about all these expenditure and not seeing revenue in the near term. So the AI rally is very much alive, and we should see that continue now that we've seen key earnings out of the way. So keep a very close eye on that. The S&P is expected to climb that wall of worry. One other factor, don't forget, that correction that we've seen over the last 3 weeks has come primarily as a result of the market pricing out the very aggressive rate cuts that we saw since the start of the year. Keep in mind, however, Mr. Powell has told us he still thinks 3 cuts this year. The market's only pricing in 1 cut right now. So if that number comes in 0.3 today, Mr. Powell's going to be vindicated. The market's going to start to price in the likelihood of perhaps a second cut, and that's going to be music to the S&P 500 and NASDAQ as we move back up towards record highs. Now, watching the price action in the US bonds yesterday, we got a very important clue. The 2-year got stuck just above that 5% yield level, and there was a massive buyer of 2 years. If you were trading the tape and you were watching, you would have seen someone who was very comfortably taking all of the sell side action, and it came in around that 5% yield on the 2-year. And this means ultimately that should that PCE print come in line today, that 2-year bond is going to fly up the page. Okay, keep in mind, like I said, Mr. Powell told us he thinks 3 cuts this year. He thinks the Jan-Feb inflation numbers were seasonal, and he thinks inflation is going to continue to trend lower. The market's only pricing in 1 cut for December, so the market is priced very hawkishly now based on what Mr. Powell thinks. Now, moving on to Bank of Japan. Yes, we got the very, very weak inflation data from the CPI Tokyo, a significant drop in inflation. Yes, there was some talk and chatter of that, but this makes the BOJ's job almost impossible, okay? If you look at what Mr. Governor Ueda said, ultimately, he told us, well, the yen's move is usually temporary, and their effects on underlying inflation could not be dismissed, especially if they pushed up wages. The reality is the BOJ is not signaling hawkish. The reality is the market's telling the BOJ, either you get to work hiking rates, either you get to work closing the differential between Japan and the United States. Otherwise, we are going to weaken and depreciate your currency aggressively. And we can see that across the board. If you go look at a daily yen chart, compare that to a pound chart against the dollar, compare it to a euro chart against the dollar, what you'll see is that the euro and the pound have rallied all week against the dollar. The yen has sold off all week against the dollar. We have got the US dollar up almost 4% against the yen this month, and that trend is set to not just continue, but accelerate. Why? Because the BOJ is in no rush to hike, and the market is saying, either you hike or we're going to push harder. This creates a massive problem for the BOJ because the reality is the only option they have to stem the flow is hike. In reality, Mr. Ueda thinks he can talk tough. In reality, they think they can jawbone and perhaps do some intervention, but that's only going to ignite further sell-side action in the yen. How these things typically work is we get some form of a liquidity event. In other words, we'll see a very significant sell-off in the yen, perhaps a 2-3% down day. That will flow over. There'll be some ripples as a result. We should see some impact in perhaps the US 10-year bonds at the same time. If US 10-year bonds do sell off with the yen, make sure you're selling those equities because it will be quite a nasty risk-off day. Now, lastly, what's the play of today over the PCE? Well, it's all down to the gold market. Why? Well, gold's been the number one star performer all year. It's been the massive outperformer. Why? Well, gold does very well in an environment when central banks tell us that inflation is going to be accepted at higher levels. That hasn't changed. That thesis has definitely not changed. If you look at the long end curves of the UK and Europe, what you'll notice this week is that 10-year bond yields are substantially higher when their central banks are telling us they're going to cut. And this is the market sending that signal to the central banks that, look, you running things hot, we're going to move those long-end yields. That puts gold firmly, squarely back up 2,400 in short order, and most definitely looking at record highs in the coming weeks and months. So gold is the play back up towards record highs. Don't forget, rate expectations have peaked. We're only expecting 1 rate cut from the Fed this year. Should that data come in line with the expectations today, dollar ultimately is going to get sold. And as a result, we will see that gold move back up the page aggressively. That's the rundown for today. Good luck for today. Make sure you manage that risk. Go make some money.